sometimes the market doesn't behave as we would expect it to behave following a release. And that could be, for example, if the headline number is as expected, but there's a subcategory which is particularly strong or weak or wasn't expected. And that can be seen, for example, in US non-farm payrolls. You might have a really strong number that was expected as the headline job creation number, but then you might find that average earnings are actually much weaker than expected. And so the market might actually end up focusing on that average earnings number rather than the headline figure. A common mistake that traders make when trading news releases is not putting in a profit taker. I think a lot of the time there's a lot of focus on getting the order in to get the trade going, and also the stop loss, which is great, thinking about risk management. But it's also essential to have a profit taker in place so that the trade is well planned and you know what you're expecting from that news release. Without it, sometimes what we see is the price goes up to where you expected it to go to before just coming straight back down, and there was no profit booked. It's really useful before the US non-farm payroll to have an idea of what the expectations are for the release. Not only just headline figures, but also the unemployment rate, the productivity level, and also average earnings. Average earnings is key right now because we're so focused on inflation. But it's also worth having a quick look at data releases across the week. So the ADP employment report, also the ISM services, the employment subsection. These can also give you clues as to whether you can expect the report to come in above or in line or below expectations. In 2023, we're seeing a divergence between the Federal Reserve and the Bank of Japan, which is really impacting the US dollar Japanese yen currency pair. You've got the Federal Reserve, which is hiking interest rates in a much more hawkish approach, which is keeping the US dollar strong. On the other hand, we've got the Bank of Japan, which has adopted a much more dovish stance, which is keeping the Japanese yen under pressure. In addition to the inflation data, central bank movements, and GDP data for the US and Canada, when you're trading the US dollar CAD, it's also a good idea to keep an eye on oil prices. Now, oil is the main export for Canada, and therefore it can influence the price of the CAD. When you see oil prices rise, that can give the Canadian dollar a boost. And when you see oil prices fall, then that can have the reverse effect. Now, it's worth keeping an eye on the EIA inventory data, because that can really give some clues as to what to expect from oil movements. When inventories are showing a larger than expected draw, that can boost oil prices, which can have a positive impact on the Canadian dollar. Meanwhile, if we see higher than expected inventory levels for oil, that can have a negative effect on oil prices and pull the Canadian dollar lower. In the June RBA interest rate decision, the central bank actually caught the market by surprise and hiked interest rates by 25 basis points. Now, this was the second straight meeting where they caught the market by surprise and hiked rates by 25 basis points and have kept the door open for further hikes. Now, this is quite interesting because prior to the meeting, expectations had been that the RBA could actually keep rate hikes paused for the rest of the year. This has changed my bias for the Australian dollar, particularly against the Japanese yen, where we're seeing the Bank of Japan stick with that dovish stance, and now we've got a particularly or a notably more hawkish stance from the RBA. At the May ECB meeting, the central bank raised interest rates by 25 basis points. And in the press conference following the meeting, ECB President Christine Lagarde was actually very hawkish and was very clear that the central bank was not done with raising interest rates. Interestingly, though, the euro actually sold off following the announcements, which was actually very unexpected. It did resume its upward climb the following day. So if you had the trade in on the euro US dollar, it would have been important to have set a really good stop loss at a level which was supported by the market structure, and then you'd have probably been able to have that trade continue higher the following day. At the moment, we're seeing very high inflation in the UK, and that's boosting bets that the Bank of England is going to be expected to continue hiking interest rates. On the other hand, we've got the US, where we're seeing inflation is starting to cool. It's perhaps a little bit stickier than we're expecting, but there is definitely a downward trend in motion. So the question as far as the Fed is concerned is, when are they going to pause and when are they going to start cutting interest rates? As far as the Bank of England's concerned, that still seems to be some way off, and that could mean that the pound is supported against the US dollar going forward.